Welcome back to the Money DNA podcast. We're your hosts. I'm Dale,
And I'm Andy.
and we're just two guys on a mission to help you ditch debt, build wealth, and live the life you were born to live. Each week, we break down money myths, serve up simple strategies, and have a little fun, hopefully, along the way.
Yeah.
Whether you're just starting out or you're chasing a $1 million dream, you are in the right place. Let's jump in and get money working for you. Last time we talked a little bit about the birthday cake and
Mm,
it was an analogy on how we can strategize or prioritize on how we can build our wealth. But I wanted to depart from that a little bit. For some reason, I just felt like there was something pushing us towards and egging me towards this idea of mortgages and debt, right? It's a bit of a hot topic right now, especially
right,
with all the economic uncertainty. You never know if those bank rates are going to go up or go down.
right,
And of course, along with that, everybody's starting to think, is this a good time to buy? Is it a bad time to
mm,
buy?
right.
Sometimes people tell you the best time to get into the real estate was 10 years ago. And
Yep,
some people will tell you, don't ever get into it. Elon
right,
Musk doesn't own a home. He rents his places. What's up with that? So it's kind of you get into all kinds of questions about mortgages, right?
right. Yep.
And I think it's a good time, Andy. I think it's a
Mm,
good time for us to really talk about and break down some of the details about
right.
mortgages and debt related to mortgages and debt
Mm,
altogether, I guess.
sure. Yep.
Uh, so I wonder if I can ask you, Andy, you have a bit of experience with this, a lot of
Mhm.
experience with this, talking about mortgages and mortgage math.
Yeah, right. And I think we wanted to start with the idea of what is the true cost of your mortgage, because it shocked me the first time that I saw it. And generally speaking, when I bring this up to other people, it shocks them as well. So rather than being blissfully unaware of how much money we're spending. This one we're going to maybe peel back the curtains a little bit. It might feel a little bit like a gut punch, but if you don't know it, Dale's got a good saying, right? I think of like a flashlight, right? If you can't find it, if you can't identify it, then you can't fix it. What's your saying, Dale? It's better than that. What is it?
Cannot tame what you
There it
cannot name.
is. Yes, exactly. You cannot tame what you cannot name. So let's name what this is and the that it is, and the different ways that mortgages are structured and financed, and then we can do something about it. So, what is the true cost of your mortgage? Let's break down some numbers for you real quick here. Okay, we're going to work off of the idea of a $400,000 loan. Okay. I understand some people are going to say, oh, that's not my amount of loan. The numbers are going to be the same or similar regardless. So we're going to start with $400,000. Okay. We're going to start with an interest rate. Again, this is 2025 when we are recording this. We're going to start at 6%. Okay. Some may find that high, some may find that low. We're going to try to shoot the middle just to give you an idea. Okay. So $400,000, 6%. We're going to come back to this idea of interest rate. Usually we call that the APR. We're going to see why this is a little bit misleading. Okay. Generally speaking, 30 years. I understand some people, if they've got a little bit more cash in their budget, they can go to a 15 or a 20 year, but we're just going to say for 360 months, that's 30 years. Okay, 360 months. Now, a logical thing to do, which I think is probably what a lot of people do, is they're like, okay, 6% times $400,000, that's probably what this interest cost is, right? Wrong. That's not. That's not the case. I wish it was. If it was, we would be talking about other things that are a little bit happier. But the unfortunate reality is that the way mortgages are financed and calculated is not on the interest rate. It's on this guy called the total interest percentage. We're going to come back to that. So I will rip off the band-aid here. I've held you in suspense long enough. The actual true amount of interest that you're going to pay on a $400,000 loans for 6% over 30 years is 463,000. Does that sound anywhere close to 6%, Dale?
Nope, not by my
Nope.
math.
Not by
Nope.
my math either. Okay. So if we add this number and this number up, the total cost for your 430 or your $400,000 house is actually $863,000.
Yeah.
That's what your $400,000 cost house cost. Okay.
And I'm just going to stop you for a
Yes,
second.
please
So
do.
it's not a $400,000 house. A lot of the time, you're putting down some kind of a deposit or something. So
Mhm.
maybe like a 20% deposit
Sure.
down. a down payment, I mean, and then
Yeah.
you're borrowing the rest of it. So let's say
Correct.
if this was a $500,000 home that you're paying for,
Hmm.
$100,000 down, and you're borrowing on a
Mm.
mortgage another 400,000, taking out
Right.
another $400,000 mortgage,
Sure.
then the total cost over the 30 years for that
Hmm.
$500,000 purchase, and this is just interest and
Yeah.
bank stuff. This is not related to
Right.
we have land transfer taxes here. We've got
Hmm.
maintenance fees or
Oh
real
yeah.
estate
Oh yeah.
fees or any of that other stuff. But this is just talking about the borrowing cost of the home.
Yes. Right.
That's 863,000 on a home that's only, that you're only buying for quote unquote
Right.
$500,000.
Right.
Yeah.
Yeah, no, and you're exactly right. So, I mean, it doesn't take a genius to see that I'm paying more in interest than the house is worth. And that, again, I promise that by the end of this podcast, we will give you hope for a better future. I realize that we're starting off hot here. We're jumping into the deep end with you. But we got to know these things, guys. Again, you can't tame what you cannot name. We are naming total interest percentage. That is what banks are charging you on. So let me give you the numbers here. It is 115%. 115% of a stated 6% APR, that's what it's going to cost you. So these are realities. You may not like them. I don't really particularly like them either, but this is facts. These are true numbers here. And I'm going to show you some different numbers because I can already imagine people out there like, hey, Andy, I got a 7% or I got a 5%. We got different loan amounts, right? So I'll say this and I'll probably circle back around to it. Banks will sell you on the APR, but they will charge you on the tip. Okay.
Mhm.
Ironic or not, I don't know sure how we want to say this, but isn't it interesting? TIP, tip. We are literally tipping the banks. We get nothing for that. That is just their money that they get for, doing such a solid for loaning us money and then loaning it back out anyways. We won't get into that. So, these are the numbers, right? So let's actually look at a couple different circumstances similar to that, but let's change the APR, which again, they're not charging you on the APR, but it is worth talking about that. Okay. So this is what a loan disclosure statement or loan calculation looks like. Side note here, they actually just in America, they just changed this from truth in lending to loan disclosure. It's no longer truth in lending, it's just a loan disclosure. I wonder what came out of that. Anyways,
Hmm.
side note.
Interesting. It's
One thing right here.
usually the other way
This
around, isn't it? Like in terms of changing the language. I wonder
one
what
would
what
one would
happened.
think. One would think. So, anyways, I don't. I'm throwing shade, but I'm trying to just float past it. You guys can linger if you'd like to. I wanted to point this out right here. This is not your interest rate. Look at your loan disclosure statements. It will say that next to APR. It will say this is not your interest rate. Again,
It says that on the actual
it
statements.
literally says it right there. It says it right there. This is not your interest rate. That's just your annual percentage rate, which is just a fancy way to say this is the low number that we're going to give you to make you feel like I got such a good rate. I don't need to refinance, or that's another whole thing. We won't get into refinancing. Dale and I had a very interesting conversation about differences between America and Canada as far as refinancing. Okay. So, again, just to kind of speed this up. So, on this $400,000 loan, actually $558,000 for the finance charges. That's what the loan will cost you. The dollar amount the loan will cost you. If you read that fine print, it actually tells you exactly what it's doing. So the total amount that we're adding up at this point, 400, 500. So we're close to $1 million for your $400,000 house. That is a tip to the bank of 140%. All right, so 140% on our 7-year rate. We've already seen the 6%, which is at that 115% tip. So let's jump all the way down to 5%. That's a good quote unquote, right? APR. What if we jumped all the way down to 5%? Okay. 5%, we're still at 93%. Okay. Some people could argue, oh, I've got a 4%, right? Okay, great. Then you're at like what, 60%? Is that Dale? Would we all agree that 93 is not 5%? Would you agree
93
with
is
that
not
statement?
five.
Is 139 7%?
No, man. No, no
No, it is
match.
not. Okay. All right. So that's a very good question. So let's segue into that, right? So we've ripped off the Band-Aid. We now know that this is an issue. Maybe we didn't know before, but let's ask the question before we get into a solution about what can we do about this? How can we shrink that process down? Um, This is a tough one. Why are we not talking about this? Is this a lack of education? Is this a conspiracy that we're all kept in the dark? I mean, you could go lots of different directions here. I have some theories. What are your thoughts? Why are we not talking about this?
I think you hit the first reason. I mean, from a sheer marketing point of view, if you
Hmm.
were the bank and your business was about lending money and making
Right,
money,
right,
then certainly it's not a great sell, like
right, right.
93% versus 5%. That it might be better to say 5% as far as selling goes on an interest rate. Um, yeah, that might be the first reason. The second thing is I think, again, marketing, more people are selling you the dream of homeownership, and
Mm-hmm.
they're not really selling you the journey and the ardor of the cost of that homeownership along the way, right? They're trying to future projecting you to the endpoint as quickly as possible, and forgetting about the steps 0 through 30 years in between, right? So
Right, right.
yeah, yeah.
Yeah.
Um, I I don't know if there's ever anybody really, at least in my experience, until I hit university, I wasn't learning a lot of finance math or mortgage
Mm-hmm.
math to begin with. So I would imagine, as far as the financial literacy, schedule goes, or the what is that when you a curriculum, the curriculum for financial literacy, if there ever was one, I would imagine mortgage math is not in the early chapters or the early introductory segments
Mm-hmm.
on financial literacy. So
Correct. It's not. I would pose back to you. I'm not saying that you agree with that, but that's just the fact of the matter, right? Um, wouldn't it make sense for mortgage math and I mean the stuff that we've talked about before, budgeting, emergency funds, all of these things, investments, all the stuff that we're, I mean, maybe this is the purpose of why we're doing this is because you're not hearing it elsewhere. So let us be your guides along the process here. Wouldn't it make sense though that before students left high school that they had a basic understanding of this because there's no guarantee after high school that they're going to go to university or go to college. Wouldn't it make
yeah,
sense that that would be an important aspect of their education?
I mean, and just speaking of that too, there's student loans, right?
Mm.
It's a bigger deal, I think, for you
Yeah.
guys down there than it is for here because
Hmm.
we get everything for quote unquote free in
Mm.
Canada, but that's another big debt load that nobody's
Hmm.
really telling you about.
Right.
Like,
Right.
hey, just come to our college. It's only going to cost you a $60,000 loan that you might be paying for the next 10, 20, 30, maybe longer years of your life, right? I
Hmm.
think there is, yeah, it's I don't want to be too like doom and gloom negative or
Nope. I
something,
get
but
it.
there has been a great growth in the credit and
Mm.
lending industries. The
Yep.
finance, like that
Yep.
part of the financial industries have grown quite a bit in the last 25 years. And I don't think that's by surprise in some sense. And I think we've been willing participants, right?
Sure.
We all, like growing up here in North America, we all want to own a home and with a white picket fence
Hmm.
and
Hmm.
2.5 dogs or 2.3 kids or whatever the statistic is. And
One
and
dog, two and a half
and
kids. Yeah.
right. One dog, one dog,
Mm.
two hamsters. That counts to about
There you go.
2.3,
There you
right?
go.
Yeah. Yeah, I think there is there's so much information and there's so many
Mm.
narratives and stories that we're sort
Right.
of tracking as we're growing up. And some of this stuff isn't really that, for lack of a better word, it's not that sexy. It's not that
Mm.
interesting. It's
No.
not very compelling stuff to be talking about or teaching or introducing.
Right.
There's movies to watch along the way. Like there's other things that we've got to keep
Sure.
our minds and brains and attentions on. So,
Yeah,
um,
that's very true. It's not entertaining. It's not fun, right? Not fun to talk about debt. Um, valid and true. I wonder, and my wife can probably overhear this from the other room. I'm not the conspiracy theorist in our relationship here, but I do think that there could be some maybe some negative or some shady actors in this whole situation because I mean we said it before. It does not behoove the banks, big fancy word, right? It doesn't help, right? They don't want you to know this because if your eyes are now open to this, like, oh my gosh, Andy, well, how do I get out of debt? We're going to get there, right? We're going to talk about that in a second, but that doesn't help them. The longer you are in debt, if you are in debt the rest of your life, that benefits them. So why would there ever be any education or literacy from the banking or the credit industry that would possibly um, put in jeopardy their income? I mean, they are for-profit entities. That is the factual matter. I have wonderful friends that are bankers. To your point, we do not need to vilify the people, but the industry themselves, like, let's just be honest, they are not in it for our benefit. They are in it to make money. If that is
Yeah,
done at
they're
our lack of knowing, then so be it, right?
I mean, unless you own part of the bank or you have
Yeah,
stocks or shares in the banks, they're not working for your best interest. They're working for
correct.
their
Right,
shareholders
right.
and the owners, right? So I mean, you can go out and buy some shares in the bank. It's kind of like somebody was telling me you can buy an Apple iPhone and spend $1,000, or you can own Apple stock and make money from people buying more iPhones, right?
Yeah,
So
sure. Yeah,
it's not to vilify Apple or any of these big corporations in any ways. They're just doing what they're supposed to do,
right.
which is in their case, making money by borrowing, and they're in the credit and lending business.
Hmm.
It's interesting point that you say about that. A kind of fun fact about from my story, and I think I've heard a few other people say the same things. At one point, I had 13 credit cards.
Wow.
Yeah. And they were mostly unused. They're mostly just sitting there, like in my wallet, this very nice big fat wallet that was
Hmm.
totally displacing my hip whenever I sat on it. And it was a complete waste. And I know it was ridiculous, right? And I got told early on when I came out of in my freshman year of university, first year, they're like, you get free credit. Like you're
Oh my gosh,
automatically
yes.
approved.
Yep.
Just being here, you just got
Yep.
to sign up your name. And then as soon as they send you one card, then every couple of years or every year they'll be like, "Hey, you're automatically approved for this card or that card." And I think they must be some kind like they're sharing the same email list or something like that.
Hmm.
The email wasn't even a thing back then. It's
They,
just
they
now.
track you down. They find you somewhere or another, right?
I mean, they share something. So,
Right.
and I fully said, "Yeah, that sounds great. I'll do all this and do all that." Little did I know that that was negatively impacting my credit score, right?
Okay. Yeah.
Too many
Right.
credit cards, you don't
Mhm.
have you're not making regular payments on something.
Right.
Even if you
Yep.
don't have a balance on it, if you're not making regular payments on something,
Right.
it's no good. But
Interesting.
what I also didn't know is after I'd cut up all but one of those credit
Hmm.
cards, right?
Right.
Then and if I paid that off, right? That's also not good for my credit score.
Yeah. Right.
They want me to be in like the higher the more in debt you are, and the better of a player you are in that credit and borrowing money game, then the higher your credit score goes, right? So you can have a lot of net worth, you can have absolutely no debts whatsoever, and that will give you a next to zero FICO score
Hmm.
or credit score, depending on whatever the credit
Right.
bureau you're talking about, right?
Hmm.
It's kind of a funky game in that way.
It
And
is.
it's like getting into the credit game, and it's really easy for us to get caught into this game and this numbers and like, oh,
Hmm.
I'm approved for $20,000 more credit. That means
Hmm.
I'm instantly $20,000 more valuable. Like my net worth had just gone up by
Yeah.
$20,000. That sounds really great on
It
paper,
does.
right? I mean, it's not true, but
Not
that's how it
true, but it
feels
sounds good.
in the moment. Like I can
Yeah.
at any moment buy something with
Right.
my $20,000 credit limit. There we
Right.
have it. Hey, there's another thing about credit cards. I mean, this is a day and age where I've never heard any of my peers saying I bought a car. Oh, and I know one person who recently bought a new car in cash. They
Hmm.
came to the dealership and here's my check or here's my thing
Right.
and paid for their car outright right out the dealership door. Pretty
Right.
much anything you have to buy now, everybody uses a card for, right? It's
Right.
it's it's
Right.
kind of the way the system has rolled.
It is. It alludes back to a conversation we had right before we started on this. I may read my little synopsis at the end right there. Looking into for a future class that I'm going to offer here in class in person, and then also maybe some stuff that I'm going to do online. Just the history of credit, the history of mortgages. It is so fascinating, and it's not as old as you think it might be. To your thought of like it doesn't even make sense, right? To buy a car on cash. I would even say there's some people that doesn't make sense for them to buy their couch in cash, right? So we
Right.
we've gone from like not using credit or it not being a thing to all the way to the point where we can't buy our furniture without credit. So I think we're going to
That's
have to table that one because that could be a interesting conversation.
for sure. Yeah, I think debt and credits is and debt management. That's one of the the layers of the birthday cake. But we definitely have to come back to
Correct.
this.
Correct.
Yeah.
Correct. All right.
Um.
So we've held you in suspense long enough. Let's get into it now. We've shared about how mortgages actually work and how you are paying way more in interest than you ever imagined paying at this point. We've alluded to the fact that the credit industry and banking industry is not in it for your benefit. They are trying to make a profit. So as long as you can stay in debt, the more money you make, or the more money they make, better to say. So here's the question: is there a better way, or is there a faster way, better to say, to get out of debt? Is there a faster way? I'm going to
Yeah.
lead this off, and the answer is yes. Yes, there is. Okay. And I will say before I dive into this, because I don't want this to feel salesy or anything like this, there's multiple ways, right? I'm going to cover one. You've heard of debt avalanche. You've heard of the snowball method. Do those help you to get out of debt? Yes, they do. I'm not throwing shade at any one of those. If you want to multiply that and go at a much faster rate, that's what I'm going to talk about here. And again, this probably would need a further conversation. So if you're interested, let's talk. But let me just give you the idea here. Okay. So if you've watched some of my other videos outside of the podcast, you've heard me talk a lot about a financial GPS. I've got a video that's specifically on GPS and the difference between using an old map that doesn't update things automatically, or when you run into traffic, or when you run into something like this, it doesn't redirect you. Compared that to and switching that over to a GPS that is adjusting in real time. Okay. So that's the idea of this financial GPS. Like we had just said, the bank and the credit cards plan is to take you on this long, winding road, 30 long years for a mortgage. It is not the fastest route. It is not the most efficient route. It is what they can get away with because they're trying to, like, hey, look at your payment is so low. That's great. Hey, you've got this great APR. Yeah, we're selling the dream at this point. We're not selling the process and what it actually is afford. Okay, so the idea is that there is a faster way, a mathematical, right? I love technology. I'm a technology guy. There's a technological, mathematical, faster way to get you through that debt. Okay. This one says as little to 5 to 7. Let's say half, right? Half to a third of the time. If we can cut our 30-year mortgage to 15 years or 10 years, someone in that range, now you're getting time back and you're getting interest back. That's really what we're talking about at this point. So that is the idea of a financial GPS. So thinking back to our what we had said before of the bank's way. So what is this going to take? This is going to take 30 plus years. And again, we could probably spend a whole other one talking about the idea of refinancing, right? They make that sound like a really good thing. It's such a good idea to refinance because we have a lower interest rate. That there's a secret in that one too. We'll get to that one later. Okay, so 30 plus years, we are going to spend hundreds of thousands of dollars in interest, right? Just bank profit. That does not do anything to us other than just keeps us in our house, right? Hundreds of thousands of dollars in their pocket. And then at the end of that 30-year loan, what do we have in our bank accounts for that? We have nothing, right? Because all of that money was going to pay off our debt. That's the bank's way. This financial GPS way, which is again, there are other options, but I don't know of another one that's as fast, right? So if we're all about speed and getting time back, what if we could do this in half the time, right? Half of the time, maybe a third, it just depends on your numbers. What if we could do this where we are cutting, again, the same idea, cutting that interest in half or a third, right? A half of the interest, so we're maybe 50,000 instead of $100,000. And then the crazy one, it makes more sense when I've got a document which I don't have at this point, but imagine this. So let's say, Dale, your 30-year loan, we're going to pay that in half the time, right? So now we've got 15 years where I'm used to paying this mortgage out. What if for that last 15 years, I start paying myself rather than the bank? So
Hmm.
the idea is that at the end of the 30 years, rather than having nothing in your bank because you were just paying off your debts, what if you had hundreds of thousands of dollars in your bank because you are paying yourself rather than your lenders at that point? Those are the options, right? These are some different things to think about as far as we know the debt problem. We know that you're going to pay interest. just throwing this out there. This is not magic. This is just math. How can we do it at a faster way to get you out of debt where you're not going to be paying till you're 60, 70 years old, not being able to retire, but being able to enjoy your retirement, go on vacations, pay for your kids' education, all that kind of stuff. So I talked a long time.
So,
That is my idea.
I'm just clarifying, Andy. So what you're talking about with this financial GPS is having something sort of almost like a GPS in the car um that is rerouting my steps, I guess, along the way to be able
Correct.
to shorten the amount of time that I'm
Right.
spending on the road. In this case, the analogy will go to paying off a loan, let's say, instead of
Mhm.
having a 30-year loan or a 10-year or a 20-year loan,
Right.
then because you have this GPS system working for you to be able to shorten that time,
Right.
then you are in theory saving on the interest, not just in theory, in reality, I guess,
In reality,
because you're
yeah,
paying it
exactly right.
over less time, you're paying
Yep.
less interest, you're paying more to you're keeping more of that money to
Mhm.
yourself
Right.
and
Right.
maximizing your time, right?
Right. The other thing that I love about the GPS analogy one, but also just the actual system itself is it is emotionless, right? I mean, we were talking about AI and like the negative things about this. There is something to be said about looking at money and your finances in a logical, mathematical way rather than an emotional way, right? It's very easy to kind of recant and kind of repeal, like, hey, my income's down a little bit, so I need to stop putting extra money towards my debt and this kind of stuff, right? It's a natural human reaction if numbers are correct there, if we're just following a plan that is just looking at the numbers, not the emotional response, but the mathematical response, it's going to pay things off much faster because it's not taking that into account. So yes, and to your point, right? The idea with GPS, like it could be good or bad, right? Maybe we got an extra, we got a bonus, right? Let's throw that in our GPS. Wow, that just multiplied my ability to get this paid off that much faster. Opposite is true. I need to buy a new car. What's that going to do? The other thing, which I'm not going to go through right now, we have this financial GPS has a pay off date, like a money back guarantee. On this date, you will be debt free. I don't know. There's no budgeting. We've talked about budgeting. Budgeting doesn't look into the future. Budgeting looks at now and what's in the past. Now we can have some foresight of like, if I make this decision, if I make this investment, if we are renting, which is another whole thing, renting compared to owning a house, what is that going to impact my future? I love the foresight of this, and I love the idea that I can get out of debt in a much faster way.
Hmm. This is wild, wild, man.
Crazy stuff,
Um,
right?
it is, yeah, it's really crazy. I wish we had more of this here in north of the border there. Um,
Right?
the 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 stuff that you're talking about, Andy, I'm thinking of, obviously we're talking about mortgages here and owning a
Mhm.
home, but could the same tools, this financial GPS,
Yeah,
could it still apply for, I mean, because there's other kinds of loans and things,
absolutely.
especially where
Yeah.
you are. You got medical expenses that people will take out loans
Yep.
for. You got
Yep.
student loans, that's a perpetual thing. Like, could the same principles apply? Could be used for shortening the timeline of those debts?
Yes. Yeah. Short answer is yes. So just to be clear, the financial GPS system that we're talking about does not really care what type of debt that you have. It's just looking at the debt load. I have a slide that I talk to people about where we show lots of different debts, right? Here's the car, here's the boat, here's the student loans, this kind of stuff. If you ask 10 financial experts their opinion as to which one to pay this off, are we doing avalanche? Are we doing this? You're going to get 10 different opinions. I love the idea that we're not going off of opinions or outdated strategies. It's math, right? What's the
Right,
fastest way to do this? Doesn't matter whether it's student loans, medical, car loans. It's just going to find the fastest route to do that. And when life happens, not if, but when life happens, it will reroute you to the fastest route still.
right. I'm just, as you're saying this, I'm imagining somebody asking ChatGPT, which bill do I pay first? And oh
Right?
my gosh, please, for
Yeah.
the love of goodness, do not ask ChatGPT
Don't
for
put your
advice.
account numbers into ChatGPT. Not a good.
Yeah, yeah. Ask there's that book, Who, Not How, right?
Uh-huh. I love that one.
Don't don't be
Love that one.
you should be asking who first. Seek
Yes.
good advice. Talk to
Yes.
us, send us an email.
Right.
You don't need to know, you don't need to know the details or anything, but
Right.
please, for the love of God,
Mm.
call us first before you ask ChatGPT, right?
Yeah, I completely agree.
Um, Andy, maybe this is a topic for another conversation, but what about for younger folks or people who are not necessarily in the home market?
Mm,
Should they be, they'll be asking, is it better to
sure.
rent versus own, right? And I know the age-old adage is, you can pay money. Why pay money to somebody else for a home that you're not going
Mm,
to own, as opposed to paying for your own property, and by the
right.
end of that time, you
Yeah.
get your own. I think we could break down maybe the math into another episode here,
Mhm.
but
Yeah.
if you were to factor in the total cost of home ownership, I would wager, depending on what the
Mm.
numbers are, that you're going to be spending less money by renting than you would be paying to a bank in a mortgage or something,
Correct.
right?
Correct. Yeah.
So, yeah, it kind of makes me wonder, like, what do you think? Is it better to rent? Is it better to own? What do you say to that?
Yeah, I think we'll have to kind of table that one for future episodes because there's so many factors, right? What is the rental market? What is the cost to rent? I mean, the very short, very simple way to look at this was we were talking before we started. If rent is 1,000 and mortgage is 1,200, that doesn't seem like that much. If you're only going to be in that house for 3 years, 5 years, does it make more sense to invest that $200 and have that grow? Yes, you're not earning equity in this point, but at the end of the time, you walk away. What if the market crashes? Then
Mm,
you're upside down, and it doesn't help at this point. So again, there's
right.
so many factors that come into rent versus own, timing, where you're at, that kind of stuff. So we'll have
Sure.
to kind of table that for another one. But
E-
good question.
e-
Good question.
Yeah, even leveraged investing, right? Like borrowing
Yeah.
money to invest money and
Yep.
and getting
Yep.
into those kinds of, it kind of touches on some of
Right.
those topics. We'll
Yep.
definitely table that for another time.
Absolutely. Absolutely. So, as we kind of wrap this up, I hope that this has been a useful one. Obviously, this is something I'm very, very passionate about. Um, and I just, it's kind of one of those things again, you can't tame what you can't name. We have named tip as the enemy, right? Bankers are not the enemy. The total interest percentage is your enemy. How do we fight that? There are other ways to do this. Again, educating yourself, even if you don't, I mean, we talk about this as well, right? Knowledge is not power. The application of knowledge is power. Now you know, what are you going to do about it? Dale mentions this all the time, and it's very true. Whether it's us or somebody else, now that you know, reach out to somebody, find somebody that you know, like, trust, and cares about you, and then they can walk you through this process. We would be honored if that is us. If not, then find somebody else. But don't sit on this knowledge because that doesn't do you any good. That's
Absolutely
my
right.
that's my mic drop. There we go. Can
I,
you
I
top
love
that,
it.
Dale?
Yeah. On that note, Andy, we're going to sign it off for this week. I look
I love
forward to
it.
continuing with you next time.
Very good. All right, we'll talk to you guys next time. Take care. See ya.